Why do smart people keep making terrible money choices? Is it just bad luck, or something deeper?
It's mostly psychology. Behavioral finance shows our brains are wired with shortcuts that lead to predictable investing mistakes. We're not rational calculators, we're emotional creatures with mental glitches.
So what's the most common glitch that hurts everyday investors like us?
Loss aversion. We feel the pain of losing twice as much as the joy of gaining. So we hold losing stocks too long, hoping to break even, and sell winners too early to lock in small gains. That's the disposition effect.
Can you give me a real example of that in action? Something I'd recognize?
Imagine you buy a stock at $100. It drops to $70. You refuse to sell because selling means admitting a loss. Meanwhile, another stock you bought at $50 jumps to $80. You sell fast to feel good. Over time, you keep losers and dump winners.
That sounds painfully familiar. What about mental accounting? Is that like treating money differently depending on where it comes from?
Exactly. People treat a tax refund or bonus as fun money and gamble with it, while being ultra-conservative with salary. But money is fungible, a dollar is a dollar. Mental accounting leads to inconsistent risk-taking.
And anchoring, I've heard that one. Is that when we fixate on a price we saw first?
Yes. If a stock was $200 and now trades at $120, you think it's cheap even if the company is collapsing. You anchor to that $200 number. But the market doesn't care about your reference point, it cares about future value.
What about confirmation bias? I feel like I only read news that agrees with my investment choices.
That's it. You seek out articles that support your view and ignore warning signs. It makes you overconfident. Overconfidence then leads to overtrading, buying and selling too much, which racks up fees and lowers returns.
And herding, is that just following the crowd into hot stocks or crypto?
Yes. When everyone buys, you fear missing out. But by the time the crowd is in, prices are inflated. Herding creates bubbles and crashes. Remember the dot-com bust or meme stocks, late buyers got crushed.
What about home bias? I tend to buy stocks from my own country because they feel safer.
That's natural, familiarity feels safe. But it means you're under-diversified. If your home market tanks, your whole portfolio tanks. Global diversification reduces risk, even if foreign stocks feel scarier.
So how do we actually outsmart these biases? Is there a practical system?
Build a written investment plan with rules. Decide in advance your asset allocation, rebalancing schedule, and sell criteria. Then stick to it. Automation, like index fund investing, removes emotional decisions entirely.
What's the single most powerful habit to protect myself from my own brain?
Slow down. Before any trade, ask, am I acting on data or emotion? Wait 48 hours. Also, keep a journal of your decisions and review them quarterly. You'll spot your own patterns and correct them.
For a beginner listening right now, what's your top actionable advice?
Start with low-cost index funds, set up automatic monthly contributions, and never check your portfolio more than once a month. Your future self will thank you for ignoring the noise and letting compounding work.
That's incredibly clear. So the goal isn't to be emotionless, it's to build guardrails, right?
Exactly. You can't stop feeling fear or greed, but you can design a process that doesn't let those feelings drive your money. Rules beat willpower every time. That's the real secret of smart investing.